everyone, welcome back to With Secure. I just discovered something super exciting and I can't wait to share it with you all today. We're talking about something that sounds super complicated, but it actually is super interesting. Bonds and their pricing. Trust me, by the end of this video, you'll not only understand bonds, but also feel like a pro investor. So let's dive in. Alright, simple. Imagine a company or even the government needs money to build roads, bridges, or expand their business. Instead of taking a loan from a bank, they issue bonds. Think like an IOU. The company or government is borrowing money from you and promises to pay it back later with interest. Cool, right? When you buy a bond, you're basically lending your money to the issuer. In return, they promise to pay you interest at regular intervals, called the coupon rate. And after a fixed period, called maturity, they return the principal amount. For example, let's say the government issues a bond worth Rs 10,000 with a 7% annual coupon rate and a maturity of 5 years. You'll get Rs 700 every year for 5 years, and at the end of 5 years, you'll also get your Rs 10,000 back. That's how bonds work. Now in India, bonds come in different flavors. We have government bonds or GSECs issued by the Government of India, super safe. Corporate bonds issued by private companies, higher risk but also higher returns. Tax-free bonds, the interest you earn is tax-free. Sovereign gold bonds or SGBs, these are linked to gold prices. And municipal bonds, issued by local government bodies to fund public projects. Okay, now here's where things get spicy. The price of a bond is not always Rs 10,000 or whatever its face value is. It depends on interest rates and market demand. There's a formula to calculate bond price. The price is equal to sigma C over 1 plus R raised to the power T plus F divided by 1 plus R raised to the power N. P is the price of the bond, C is the coupon payment or interest paid per year, R is market interest rate or the discount rate, T year number, F face value of the bond, 10,000 in our example, and N total number of years until maturity. Let's say a bond has a face value of Rs 10,000, a 7% coupon rate, and a maturity of 3 years. The market interest rate is 6%. Now using the formula, we have P is equal to 700 divided by 1.06 raised to the power of 1 plus 700 divided by 1.06 raised to the power of 2 plus 700 plus 10,000 divided by 1.06 raised to the power 3, which gives us 660.38 plus 623.40 plus 8,986.56, which is approximately equal to 10,270.34 rupees. So since the market rate is lower than the coupon rate, the bond is priced higher than its face value. If market rates were higher, the price would be lower. If you want to calculate bond price in Excel, use the PV function or the present value function. Now, it's equal to PV, rate, NPER, PMT, FV, type. So for the above example, rate is equal to 6% market interest rate per period. NPER is equal to 3, number of periods, that is years. PMT is equal to negative 700. Negative because it's cash outflow. FV is equal to negative 10,000. Again, negative because it's the amount to be received at maturity. And type is equal to 0. Payments occur at the end of each period. This will return rupees 10,270.34 rupees, matching our manual calculation. Another important term is yield. It tells you how much return you will get based on the bond price. The formula for yield is annual coupon payment divided by current bond price multiplied by 100. So if you buy a bond for rupees 9,000 instead of rupees 10,000 and it pays rupees 700 in interest, your yield is equal to 700 divided by 9,000 into 100, which is equal to 7.78%. See, the lower the bond price, the higher the yield. Now the big question, should you invest in bonds? Well, if you're looking for stable income and lower risk, bonds are a great choice, especially government bonds, which are super safe. But if you're young and want higher returns, stocks might be a better option. You can buy bonds through RBI Retail Direct, stock exchanges like NSE and BSE, or mutual funds that invest in bonds. And that's a wrap. I hope this video made bonds easier to understand. If you found it useful, don't forget to like, share and subscribe. Also, comment below, would you invest in bonds? Let's discuss. And hey, if you want to support this channel and help us bring more awesome content, consider joining our membership program or using the thanks feature to show your support and appreciation. Every bit of support helps us keep creating quality content for you. See you in the next video. Until then, happy and safe investing. Bye-bye.